I want to tell you about the day I realized the financial system doesn't actually protect you. It never was designed to. It happened on a Tuesday afternoon. I was sitting at my kitchen table, looking at my brokerage account. My portfolio was up actually doing well on paper, and then I did something I'd never bothered to do before. I clicked on the details. I looked at exactly where my money was sitting, and I froze. Because what I thought was a diversified index fund, the thing every financial advisor, every YouTube video, every personal finance book had told me to buy was 31% concentrated in 7 companies. 7 out of 500. That's when a story came back to me. A story I'd read years earlier and half forgotten. A story about a man in a powdered wig who convinced an entire country to hand him their savings, and then watched it burn. His name was John Law. And in 1716, he walked into the French court with an idea so bold, so seductive, that an entire government said yes before they fully understood what they were agreeing to. France at the time was broke. Louis XIV had fought too many wars, spent too much gold, and left behind a debt that was strangling the country. The treasury was empty. People were desperate. And into that desperation walked John Law, a Scottish gambler, economist, and financial genius with a simple pitch. Let me print paper money backed by future profits from French territories in America. We'll get rich. France will get rich. Everyone wins. The French government, out of options, said yes. Law created the Banque Royale and the Mississippi Company, a firm that supposedly held rights to all that fertile, gold-rich, trade-booming land in Louisiana. He started issuing shares. People bought them. The price climbed. Friends told friends. And then something strange and dangerous happened. The rising price itself became proof that the company was valuable. In less than 2 years, the share price went from 500 livres to 18,000 livres. 36 times your money. People were selling their jewelry, their homes, their farmland, anything to get more shares. They camped outside Law's house at night, hoping to catch him in the morning. The word millionaire, coined right here, during this exact moment, entered the French language for the first time. There was one problem. Louisiana wasn't rich. It was swampland. There was no gold, no thriving trade, no revenue. It was a story, a beautifully told, government-endorsed story built on nothing. When people started asking to convert their paper shares back to gold, Law didn't have the gold. He printed more money to cover the shortfall, which inflated the currency and made everything worse. By 1720, the whole thing collapsed. Shares that had traded at 18,000 livres fell to zero. Families who had been rich on paper woke up with nothing. France banned paper money for decades, and John Law fled the country and died broke in Venice 9 years later. Here is what I keep thinking about, though. The people who lost everything weren't fools. They weren't reckless gamblers. They were ordinary French citizens who trusted the system, who believed the government, the bank, the experts, who did what they were told. And that's exactly the problem. Because trusting the system blindly, without looking under the hood, is still how most people invest today, including, until very recently, me. I've been investing for about 12 years. I started the way most people do. I read a couple of books, listened to some podcasts, and landed on the same conclusion everyone lands on. Buy a low-cost index fund that tracks the S&P 500, contribute consistently, and don't touch it. Simple, passive, boring, perfect. And for a long time, I was proud of that decision. I didn't panic during downturns. I didn't chase meme stocks. I was the responsible one at dinner parties who said things like, I'm in it for the long term, while everyone else was stress trading. But that afternoon at my kitchen table broke something open for me. Because what I thought I owned broad, diversified exposure to the American economy wasn't actually that. What I owned was a massive bet on 7 technology companies: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla. 7 companies representing 1.4% of the index, holding over 30% of my money. Nobody had lied to me exactly. But nobody had told me the truth either. And there's a version of dishonesty that lives exactly in that gap. So I started digging. And the more I dug, the more I kept running into the same pattern in history, in markets, across centuries. A pattern that looked uncomfortably familiar. Let me take you back to 1972. America is thriving. The economy is humming. And Wall Street has arrived at a consensus, a beautiful, logical, reassuring consensus. There are 50 companies so dominant, so well-managed, so essential to American life that you don't even need to look at the price. Just buy them and hold forever. They called them the Nifty 50. Household names: Kodak, Polaroid, Xerox, Avon, Sears. These weren't sketchy startups. These were the bedrock of America. The institutional investors, pension funds, university endowments, the people managing other people's retirements poured money in. The prices went up, which made people more confident, which made more money pour in. The classic feedback loop. Some of these stocks were trading at 80 times earnings, which is insane. But analysts explained it away. Growth will catch up. These companies are special. Then 1973 happened. Oil crisis, inflation, recession. Growth didn't catch up, and the stocks with the furthest to fall fell the furthest. Polaroid dropped 91% from peak to trough. Avon fell 86%. Xerox dropped 71%. If you'd retired in 1972, confident in your Nifty 50 holdings, you might have waited 25 years just to break even. Not adjusted for inflation. A full quarter century. Gone. The companies weren't frauds. They were real businesses with real products, but the price paid for them assumed perfection forever, and markets don't do forever. What happened after the Nifty 50? The pattern repeated 20 years later with dot-com stocks, then again with housing in 2007. Same structure, different costume. And I genuinely think we're watching it happen again right now, just with better branding. I want to be careful here, because I'm not saying any specific company is bad. I actually own some of these companies directly, in a separate account by choice. What I'm talking about is price relative to reality. That's it. Take Nvidia, genuinely revolutionary technology. The company that makes the chips powering most of the AI infrastructure in the world. Real product, real revenue, real competitive moat. In 2023, Nvidia's market cap was around $300 billion. By early 2026, it had crossed $3 trillion, a 10 times increase in under 3 years. Their revenue grew, but not 10 times. What grew 10 times was the multiple, the amount investors were willing to pay for each dollar of earnings. That multiple expansion is exactly what happened with Polaroid in 1972. It's exactly what happened with Cisco in 1999. And because of how index funds work, they're weighted by market cap, meaning the bigger the company, the more of your money flows there automatically. Nvidia is now a massive chunk of the S&P 500. So is Apple, so is Microsoft. So when I buy the market, I'm really buying a concentrated position in a handful of companies priced for continued perfection. Here's the math that kept me up at night. If Nvidia drops 50%, which is not some fringe scenario, it's happened to every high-flying tech stock, eventually that single stock would subtract almost 5% from the entire S&P 500. Add in similar drops from Apple, Microsoft, and a couple of others, and you're looking at a 20 to 30% loss, even if the other 493 companies do just fine. You didn't make a concentrated bet, you just bought the index. But concentrated is what you got. One more story, and then I promise we get to what I actually did about it. Japan's stock market is the largest in the world. The Nikkei index hits 38,915. Japanese companies are buying American skyscrapers. Goldman Sachs is flying analysts to Tokyo. Every expert says the same thing. Japan's economic dominance is inevitable. Stocks are trading at 60 times earnings. It's fine. Growth will catch up. You know what happened. The market crashed. The Nikkei lost 75% over the next few years. It bottomed around 7,000 inches 2003. And as of 2026, 37 years after the peak, the Japanese index only recently recovered to its 1,989 highs. 37 years of zero real returns for investors who just bought the index and held. The market always comes back is only true if you're talking about the global market over a century. Specific markets, specific country, specific sector, specific era can stay broken for decades. Decades you don't have. All right, here's the part I actually want to talk about. Not theory, not history. What I did. What changed in my own portfolio after that kitchen table moment? Step 1. I looked at my real exposure. Not what I assumed I had, what I actually had. I pulled up every fund I owned and added up the top 10 holdings. The number was staggering. Over 28% of my entire net worth was sitting in 7 companies I'd never consciously decided to be that exposed to. 5 minutes of actual research I should have done years earlier. So I started shifting, not panic selling everything that's the wrong move, but deliberately redistributing the weight. I moved a portion into equal weight index funds, where all 500 companies get the same allocation regardless of size. Less exciting in bull markets, far more resilient when the expensive stuff corrects. I added international developed markets. Europe and Japan are trading at valuations that look cheap compared to US stocks right now, 5-year lows on a relative basis. I'm not predicting they'll outperform. I'm just not willing to bet everything on one country's market continuing to dominate forever, because history says that's a losing bet eventually. I added real assets, REITs that own actual physical property, commodities exposure, infrastructure funds, things that do something useful when inflation picks up. Because inflation doesn't announce itself, it just shows up one day and starts eating. I set valuation rules, automatic triggers that force me to rebalance before my emotions talk me out of it. If any single stock becomes more than 8% of my portfolio, I trim it. If the S&P 500's price-to-earnings ratio goes above 30, I move a chunk into bonds or cash. If the top 10 holdings in my index fund exceed 30% of the total, I shift money to equal weight alternatives. These aren't market timing, they're valuation discipline. The kind of thing every major endowment does, but retail investors are told they don't need to bother with. And then this is the one I feel most strongly about. I built an income floor outside the market. I kept 12 months of living expenses in a high-yield savings account. Not because that money grows fast, because that buffer is the reason I won't panic sell at the bottom. During 2008, the people who had cash bought stocks at 50% off. The people who didn't have cash sold stocks at 50% off to pay their mortgage. Same crash, opposite outcomes, entirely based on having a cushion. I also started thinking harder about income that doesn't depend on portfolio value. A consulting side project, a small rental property. Things that generate cash whether the market is up, down, or sideways, because desperation makes you sell low, and freedom, even a little financial freedom, makes you think clearly. If I were starting from scratch in 2026, here's roughly how I'd structure things. Not financial advice, this is what makes sense to me, with my risk tolerance and my timeline. 30% diversified US stocks, equal weight or tilted towards small and mid-cap value. 20%. International developed markets. Europe, Japan, Australia. 10% emerging markets for long-term growth exposure. 15% real assets, REITs, commodities, infrastructure funds. 15% bonds, a mix of treasuries for safety, corporate for yield. 10% cash or short-term equivalents. Notice what's missing. A standard cap-weighted S&P 500 fund. I'm not opposed to those funds in principle. In another market environment, they're perfectly fine. But right now, the concentration risk is too high for me to just set and forget. Will this portfolio beat the S&P 500 if mega-cap tech doubles again? No, absolutely not. I'll underperform. And I've made my peace with that. Because what I'm optimizing for isn't maximum upside if one specific thing keeps happening forever. I'm optimizing for surviving whatever comes next. Here's the psychological shift that took me longest to make. For years, I treated my portfolio like a plant. Water it with regular contributions. Leave it in the light. Check it once a year. Hope for the best. That worked brilliantly from 2009 to 2021. Falling interest rates, expanding multiples, money printing those were tailwinds so powerful that almost any passive strategy looked like genius. But those tailwinds are gone. Rates are higher. Valuations are stretched. You can't just plant money and walk away anymore. What you can do is treat investing like a garden instead. You still sow and water, but you also prune what's overgrown. You pull weeds before they take over. You rotate what you grow based on the season. That's not day trading. That's not obsessing over CNBC every morning. It's quarterly check-ins where you look at what's gotten expensive, trim it back, and add to what's been left behind. Boring? Yes. Sustainable? Absolutely. Wealth isn't built by hitting home runs. It's built by never striking out so badly that you can't get back up. The people who got rich and stayed rich are the ones who didn't blow up, not the ones who made the most in a bull market. John Law died broke in Venice. Not because he was stupid, he was arguably one of the most brilliant financial minds of his century. He died broke because he built a system that looked solid from the outside, that everyone endorsed, that felt safe to be part of. And then one day, the questions started, and there were no answers. I'm not saying your index fund is the Mississippi Company. I'm saying that if you haven't looked at what's actually inside it, if you're assuming that diversified means something it might not, then you're trusting a story without checking the popular details. So tonight, just do one thing. Open your brokerage account. Click on your biggest fund. Add up the top 10 holdings. See what percentage of your money is sitting in a handful of companies you never consciously chose to overweight. That number might surprise you. It surprised me. And that surprise, that one moment of actually looking, might be the most valuable financial decision you make this year. Thanks for watching. If this made you think about your own portfolio differently, subscribe because this is exactly the kind of thing I'll keep talking about. And share it with someone who's been meaning to check their investments and keeps putting it off.